Hi, we are going to learn about earning money. First step is to learn about cash flow. Cash availability in a business at any point in time contributes significantly to its day to day liquidity condition. It is thus essential for any business to be aware of its cash flow periodically. To do so, one must, therefore, have a basic understanding of the flow of cash along with its forecasting methods. Cash flow definition. Cash flow refers to the inflow and outflow of the amount of cash or its equivalents in business. It determines the amount of cash consumed or generated for a specified period. Its analysis also identifies the existing sources of the flow of cash along with the possible scope of inflows. The current flow of cash for a given period is identified by reducing the opening balance of a given period from its closing balance. Once calculated, cash flows can result in a negative or positive balance. A positive balance implies that the company has sufficient cash to fulfill its immediate liquidity requirements, while a negative balance indicates a constricted liquidity. The cash flow of a company must, however, be analyzed along with the company's income statement as well as a balance sheet to determine its actual liquidity position. Also, an increasing flow of cash may not always be a positive indicator and must be analyzed thoroughly to arrive at a definitive conclusion. Types of cash flow. Cash flows can be divided into three main categories depending on their source or utilization. They include the following: flow of cash from operations. It specifies the cash generated out of an entity's core business activities. When preparing a cash flow statement, cash inflows and outflows from operations are recorded in the first section. Cash inflow here mainly includes the money received after the sale of goods or services. Outflows of cash from operations comprise operations expenditures such as rent payments, cost of goods sold, etc. Flow of cash from investments. It represents any changes, i.e., increase or decrease in long-term assets of a business. It can be represented by the purchase of fixed assets, any loans extended by the entity, any gains assumed on an investment fund and the likes. Flow of cash from financing activities. Cash inflow or outflow from financing activities is recorded if an increment or reduction in the long-term debts, liabilities, business capital or dividend is observed. A cash flow example from financing activities would encompass principal or interest payments, stock repurchase, dividends issued, liabilities incurred, etc. During cash flow analysis, the periodic balance calculated for these types of liquidity flows is subjected to various measurement parameters to identify the company's liquidity position and other financial aspects.